Good morning all, and welcome to this morning's webinar on Academies Finance Update. Hopefully you can all see and hear me, and hopefully you can see my slides in front of you on your screen. Bit of housekeeping just to get us started this morning. Hopefully you can all hear me perfectly well through your computers. But should the audio fail, you can call in with your mobile phones. Please just make a quick note of the telephone number, the access code and the webinar ID that's on the screen now, just in case we have any issues with the telephone here and you can still hear my voice through the access code on your screen. Now, fingers crossed, we don't have any technology issues. I am at home today, so I'm running this through a home broadband connection. All being well, we should be perfectly fine. You should hear my voice, you should see the slides, and we've got some lovely polls to have with you as well today. All being well, it all works, fingers crossed. You are more than welcome to ask questions throughout the webinar. I'm awful at multitasking, to be honest with you. Obviously, I'm having to talk through my slides, click a few buttons and some other things. So answering questions is somewhat difficult for me, normally at the best of times, never mind when I'm trying to do 2 or 3 other things. But I will try to answer as many as I can, either throughout the webinar or likely at the end of the webinar. And if we run out of time for some reason at the end, I will come back to you all on your questions. And those questions that you send can be confidential, so they don't have to be shared with the rest of the delegates here on the webinar itself. Equally, if you prefer to ask a question direct, you're more than welcome to drop me an email and I'll happily respond with any personal questions or queries you may have in relation to the webinar, or any questions you may have in relation to your trust or your skill that you have, and I'll happily respond to you directly there. We will be recording the session, so heaven forbid something disastrous happens, we lose connection or something, then we have got a recording of the webinar and we will be sending the recording out to everybody so you can watch it back at your leisure if you do choose to do so, or if for some reason you obviously have to rush off or can't finish the webinar, or we have some sort of technology issues today. Now, a little bit about me. If you've been on one of my webinars, you know who I am. I'm Alex Makinson. I'm a partner at Mitchell Charlesworth. I'm an accountant and auditor, and I've been an accountant and auditor for 20 odd years. I'm getting long in the tooth now when it comes to accountancy and auditing. And one of my areas of expertise and specialisms is actually academy schools and academy trusts. And that's the reason why I'm here presenting today and talking to you with the Academies update, because it's something I do every day of the week. Now, I'm a partner at Mitchell Charlesworth, that's my firm, and we've got a number of offices throughout the UK here. And we actually sit on the ESFA Auditors Forum panel because we act for a significant number of academy schools. We do know what's going on at the department. We get that insider knowledge. There's only a handful of firms that sit on that Auditors Forum. And we're also part of the Creston Group, which is a group of accountants acting for academy schools across the UK who are probably the leading group. I think last count it was over 500 trusts and thousands of schools within that we act for within the Creston Group. Now, we've got an awful lot to get through today on the agenda. Oh, I've clicked too much already and I've gone to my first item. I'll get back to the agenda. An awful lot to go through on the agenda today. It's probably going to take me about an hour. My team have very kindly slotted in an hour and a half because they know me very well. And if you have been on one of my previous webinars, you'll have probably noticed I do have a tendency to overrun a little bit because I rabbit on too much. So they give me an hour and a half in the hope that I'll certainly be finished within that hour and a half. I think I'll be finished within an hour, although we have got quite a lot to discuss today, quite a lot to get through, and I've been very sneaky and I've actually tagged an extra item on the bottom of the agenda, which I've not shown here on the slides, just because we've had some recent announcements in the last week, and even some announcements over the last day or two, which you may or may not want to hear about, and I'll just talk to you about them at the end of the session. But hopefully we should all be finished within an hour, subject to any questions at the end, It would do take a little bit longer, then I'm still within that hour-and-a-half window, but it does mean that you've got a little bit of time to yourself afterwards. So let's get started with the first item on the agenda, which is the post-audit checklist. And I'm going to actually try to launch a poll in a few moments. And if you've been on one of my webinars before, I've used polls before. What these do is they allow you to interact with me being the presenter, and it allows me to share your views with the rest of the delegates confidentially. They don't see what you've clicked on your button in the poll itself, but they do see what the percentage is when it comes to a poll. But before I talk about the poll itself, and before I launch the poll, I want to talk about audits and external audits, because that will lead us very nicely onto the post-audit checklist. Obviously, we've all been frantic finishing off certain things over the last few months. When it comes to our external audit, we're normally frantically finishing it off before Christmas. And we very thankfully this year, because of COVID, got that extension to the end of January. So in effect, we got an extra 6 weeks to complete all of our audits this year, which was very gratefully received, I think, from everybody. Although I was a bit shocked and surprised, because as auditors, we've bE petitioning to the DfE and the department for many years to extend that deadline, because it is one of the shortest deadlines for filing for any single entity. 4 months for filing your year-end accounts and completing your audit is exceptionally tight. And historically, the department has said they couldn't extend it. There's no way in the world they could extend the deadline, because there's government accounts that have to be prepared and submitted. Obviously, once more pandemic, and they are able to extend the deadline, and we got that extra month, which effectively was 6 weeks for everybody because of Christmas. I think that was gratefully received by everybody. But this year's external audit was very, very different, I think, for everybody, to be honest, because of what happened with COVID. And audits, in my view, were undertaken one of two ways this year. They were undertaken, I'm going to say the old-fashioned way now, where your auditors came and visited your schools and visited your trust and visited your head office and carried out the audit as they naturally would, by sitting on a desk, asking you loads of questions, demanding certain things off you, looking at your computer system and everything else. And I'm calling that the old-fashioned audit, really. Or they did what I'm calling a remote audit. So in other words, the auditors sat at the comfort of their desk, at home or in their office, and did a remote audit through Zoom or Teams, or used specialist dedicated software like Inflow, as an example that we use in our offices, to actually facilitate the audit remotely, which I think went down very, very well this year, and will probably be the way forward for all external audits going forward. So I'm going to launch a poll now, which is just to ask you and your trust, how did you actually prepare your audit this year? Was it done remotely, or was it done through the old-fashioned way? So you should see on your screen now a poll, a blue box. If you can tick yes, no, or in part of whether your trust had a remote audit this year. I'd be interested, and I'm sure everybody else would be interested to see and hear how many trusts actually did a remote audit. How many trusts actually didn't have the auditors in the office for their week or 2 weeks and actually did it remotely. I'm just going to keep that poll open just for a few seconds longer, not very long. Hopefully you can click a button. I appreciate sometimes the polls don't work for every single computer. Apologies here. Apple Macs it certainly doesn't like. Hopefully it will work for you here. Okay. In a second, and hopefully she can share the results with you. So fingers crossed the results. Oh, that's an interesting result then, an interesting outcome. 56% of trusts did a remote audit. The majority, slightly, 12% no, did it through the old-fashioned physical way, and a few in part. which is a bit of both, really, isn't it? Where the auditors maybe turned up for a few days, but not the whole week or the whole 2 weeks or so, and then collected the rest remotely. So I thought it's interesting to sort of share that, because I think going forward, you might find that remote audits become the norm rather than the exception because of what's happened with COVID. So we'll just close that poll now and go back to the slides. The one interesting thing with remote audits, I think I'd like to just feed back with you here, and it'll take us very nicely onto the post-audit checklist, is there is lots of pros and cons to do with remote audits. Obviously, you and your staff get a lot of information being requested from you when you have the auditors with you on site. It's quite intense, it's quite time consuming, it's quite demanding. You almost have to clear your diary for that 2 weeks or so. With remote audits, you usually get a long list of information to be provided, and you can work through that list over time. So when actually it comes to the date when the audit is happening, your time is spent doing something else, because you've almost given the auditors an awful lot of information in advance, and they don't need to hassle you so much. So there are lots of pros to doing remote audits. The cons from our perspective is they tend to drag on a little bit longer, only because you're having to filter through all of that information and then double check or ask for more information, follow-up pieces of information from yourselves. The auditor comes back to you and says, thank you for that, could I also have this as well, just to explain what's going on. So the process does seem to take a little bit longer. But I think the whole from our clients is actually people did enjoy remote audits and will probably be taking on remote audits going forward using the specialist software that auditors now have in relation to how they produce these remote audits. Now, the first item on the agenda, obviously, is the post-audit checklist. We've all been frantically finishing off certain things. We were finishing off the audit, and obviously the AAR is the most recent one that auditors and trusts have been dealing with. But as we go through these things, we often forget what we're doing because we're frantically trying to meet one deadline, not caring about another. And these are what I call the forgotten things, because I often hear and see these things being missed by trusts and schools. And the first one is the Companies House submission. You've submitted your accounts to the Department of Education. You had to do so by the end of January this year, normally before Christmas, although the deadline's technically the 31st of December. But you have an obligation to submit your accounts to Companies House. And if you fail to submit your accounts to Companies House, there is a fine and penalty to do so. I am shocked and surprised when I see trusts that forget to do that, and then they get their fine. Why? Because it needs to be done by May, but there's nothing to stop you doing it now. If you haven't submitted your accounts to Companies House, do so. It's very straightforward. Do it through the post. It takes 5 minutes. Don't leave it, because if you leave it, you miss it, you get the penalty. It's as simple as that. The next item I've got on my list is the financial statements on the trust's website. When I'm looking at trusts as an outsider, and maybe I'm an interested party in that trust, or maybe I think that trust would be a great client for me, or maybe that trust has invited me to join their board, I always look on their website. It's a great piece of information, and I'm shocked and surprised on how many trusts still do not publish their financial statements on the website, or if they do, they're out of date and they're wrong. And also they do the same thing. They look on your website for certain things, and if your trust financial statements are not on your website and out of date, then technically you are in breach of the Academy's financial handbook, and you could get a regularity report notification from your auditors by failing to comply. Now, the deadline for this year is the 28th of February. So you've got a couple more days to make sure that your August 2020 accounts signed are on the Trust's website for view for download. And reality is, I'm not sure anybody actually looks at them apart from auditors and maybe Ofsted every now and again. That's about it. But it is a requirement. You must publish it. Don't forget it. If you haven't done it, make a little note, and please do so a couple of days just to get that one sorted out. The next thing I have on my list is the CT600 corporation tax return. And I'm going to get a little bit technical here, so sort of forgive me, but I think it's interesting just to know this. even if maybe you don't understand some of the terminology surrounding it. Now, Academy trusts are in effect charities, and they are exempt charities. That means they don't pay corporation tax on most of their income. Some charities are also exempt from submitting the CT600, but not all, and the vast majority should still do so. And there is a deadline in relation to the submission of that CT600. Now, there are some lovely complications when it comes to corporation tax and academies, and you have to be very careful around certain things. One of those examples are trading income. If your trust has trading income in excess of £80,000 in a year, then you're not only obligated to submit this return, but you could have a tax bill to pay as well, because you could have tax to pay on that trading profit in relation to that trading income. Now, you're probably all sat at your screens now going, oh, I wish I had £80,000 worth of trading income. That's a heck of a lot of uniform sales. Well, actually, there's quite a few other areas that are deemed trading. So if you're a primary trust, maybe, you might have a nursery or two. Well, nursery income and parental contributions towards nursery income, that's trading income. That's not deemed educational income. And it's very easy to earn £80,000 worth of income from a nursery. Equally, if you're secondary, you might have a sports hall or centre or a swimming pool. When you rent this out, that can easily exceed £80,000, and that can result in tax and in the requirement to submit a CT600. What you may have seen is a more common practice now that's happening with trusts as they start to grow and become bigger. And maybe the smaller trusts that had 2 schools, that become 5 schools, that become 8 schools, they've started setting up trading subsidiaries to almost get around the tax consequence that comes with this complication. And whilst I don't want to labour the point of trading subsidiaries, the sort of way it works is all the trading income goes into the trading subsidiary, it makes a profit, and then it makes a donation equal to that profit to the trust, to the schools, which counteracts that profit, and the tax becomes nil. Equally, trading subsidiaries have got lots of benefits in the sense of they don't have to follow the same terms and conditions of schools. So if you've got nurseries in a trading subsidiary, then, for example, you may not have to pay the LGPS pension contribution, which is a horrendous amount of money you have to pay, 20-odd% into a pension scheme. Whereas a trading subsidiary and a new nursery, all they have to do is comply with auto-enrolment legislation. Well, that's 3% pension contribution, and that's exactly what every other private nursery around the corner does. But as a school, you have to comply with schools legislation. So trading subsidiaries are becoming more and more common, and often that is linked to the requirement of CT600s and the tax complications around them. Hopefully I wasn't too techy on that one and labouring that too much. The fourth point I've got in my checklist is to do with ESFA and the National Audit Office, the NAO notifications in relation to your financial statements. If your trust was unfortunate enough to have any sort of modification in your financial statements, so you will know that in your financial statements, you've got 2 reports that your auditor reports on, the audit report and the regularity report. The audit report to say, is the financial statements true and correct? Do they show a true and fair view of the finances of the trust? And then the regularity report is all about, did you follow the rules and regulations of the Academy's financial handbook? Audit qualifications, audit modifications are rarer. Regularity modifications are quite common, to be honest, because it's easy to fall foul of one rule within the Academy financial handbook. And this year, dare I say it, there are a few that have fallen foul within the Academy financial handbook. The most common, it's still here, related party transactions. Trusts are still falling foul of related party transactions. They're still engaging with related parties above £2,500 and not notifying the ESFA as well. That causes a breach, that causes a modification, within the regularity report. One of the other ones that seems to have been most common this year was to do with the alcohol change, in the sense of trusts should not be purchasing any alcohol unless it's for religious purposes. And in other words, if you've got a Christmas party and you bought alcohol, then you're in breach, I'm afraid, and that should have led to a regularity report matter. The thing that people forget about is that if you've got any change in relation to your regularity report or audit report, you have to notify both the Education and Skills Funding Office and the National Audit Office separately. And there is an obligation within the Academy's Financial Handbook for you to do that, as well as your auditor. Don't miss it, because you can be pulled up on it as well. So they're the main 4 items that I pick up on when it comes to the forgotten things post-audit and post-preparation of your external financial accounts. Hopefully you can all tick them off and say, yes, we're perfectly fine, that's wonderful. If there is anything you've missed there, then obviously just have a quick look and sort it out. The second item on my agenda is internal audit reviews. This is a slide that I've actually just plucked from one of my previous webinars. So if you've been in one of my previous webinars, you've probably seen this slide before, but I thought it's just worthwhile, just for 2 minutes, just going through this, because things have changed when it comes to the internal scrutiny, internal audit side for Academy trusts. I think we all know now that your external auditor cannot be your internal auditor for this year. You have to segregate the roles. And if you had your CFO doing the report historically, they can't do it this year either, because they can't check their own work. That's not allowed. And the new options are shown on the screen here. In other words, you can go out to a third party, another accountant or auditors. You can have peer-for-peer reviews. You can ask another trust to come in and their CFO do you and you do them. There's lots of other options available. But this means there's been a number of changes around internal reviews and internal scrutinies. And the first thing I'm often asked now is, we've got a change of name. It used to be called Internal Audit Report. It's now called Internal Scrutiny Report. What's different? What's changed? Why have we got a change of name here? Does that mean there's lots of different things coming on? And the reality is here is auditors like myself get very upset when the word audit is used to describe a non-audit service. What you have received in the past, however you've done it, has not been an internal audit. It's been an internal review. It's been an internal assurance. Someone coming in, sampling and checking certain things, but they haven't followed the strict laws and regulations and rules that govern audits. So we've been saying to the Department for Education, for the Education and Skills Funding Agency, please remove the word audit. It shouldn't be there within this concept. It shouldn't be there within this terminology. It's wrong to say that accountants and CFOs are undertaking audits and internal audits when they're not. So they've actually listened and they've changed it. We wanted them to use assurance because that is what it's called. You're providing some sort of assurance or reassurance to trustees. They came up with scrutiny report, so we've gone with scrutiny report. So to answer that question, what is the difference? And the difference is absolutely nothing when it comes to the name. The name is the same. You're still having the same thing undertaken. It's just called something different. It's as simple as that. Now, the DfE have updated their guidance. The guidance is quite new. It was published in January 2021. So you may have missed it with everything going on with COVID and everything else. And that's going to form the basis of what I'm going to talk about here today when it comes to internal scrutiny. I have put a link on the screen to the website. You're welcome to go on it. You're welcome to download that guidance. It's the DfE guidance itself. And I think it does answer an awful lot of questions that you may have, your trustees may have in relation to internal scrutiny. And hopefully my slides and what I'm going to talk to you about today will as well. And they sort of mirror each other in certain things. So when it comes to internal scrutiny, I am often asked a number of common questions. And the first question I'm always asked by my clients or by potential new clients when I'm quoting for internal scrutiny work is, who decides what to look at? Should it be the trustees? Should it be the audit committee? Should it be the auditor? Should it be a combination of all of them? Who decides on what to look at? It's sort of question number one I'm often asked. Then I often get asked, how is that linked to risk management? I've heard risk management referred to in relation to internal scrutiny, but I don't really understand how that really interacts. Can I please explain it to them? Is often the second question. And the third question I get asked is, what approach should be taken? How should we undertake internal scrutiny for our trust, really? And these three questions, dare I say, are interlinked. They always change the other one. And I've specifically put risk management and assessments on the top here in this sort of triangle diagram, because that leads everything. That's the starting point when it comes to internal scrutiny. And as I go through my slides in a few minutes, I hope that we'll answer those questions. I hope that you'll be able to answer those questions, and I hope it points you in the right direction in how your internal scrutiny reports should be done for your trust. And if you're doing it the right way, then wonderful. If you're not doing it the right way, then you may choose to change, or you might be happy with the way you're doing it. This is the guidance of the DFE. This is what they're wanting you to do. Obviously, it's good practice to follow what they're suggesting, but equally, every trust is different, and they have to be conscious of that, and you have to be conscious of that. Now, before I talk a little bit about internal scrutiny, I'm going to launch another poll, and my colleague is going to launch another poll in a minute, so hopefully you can all contribute here. So this poll is all about risk assessments. And what I want to know from you is, do you use your risk assessment and your risk management status and reviews to dictate what internal scrutiny work is undertaken? So in other words, do you look at your risk assessments and tell your internal auditors, I want you to do that because my risk assessment says this? So hopefully we can launch a poll now. My colleague can bring up the poll, all being well, and it should be on your screen. So if you think your risk assessments dictate what internal scrutiny work is undertaken for your trust, click yes. If you think it's no, if you think you use a bit of it, then obviously in part. I'm not going to leave this poll open for a huge amount of time. I think if you can click it, you normally do quite quickly, really. Here, it doesn't take a long time to click the button, unless you're struggling. Okay, so can we hopefully close that poll and maybe share the results, all being well? Oh, interesting. Okay. Now, I thought we'd have quite a few more no's, to be honest. 11% yes. That's not a shock and not a surprise, really. I expected less than 11%, to be honest. The bit that shocked me there is the in part, because I thought most people would go no, to be honest. They don't use your risk management and risk assessments to dictate how your internal audit is undertaken. I'm glad that a few of you have clicked in part, because it means at least you're doing some of it the right way, and it might be you've got a bit of a hybrid approach when it comes to what you're asking your internal auditors to do, or how you're sort of dictating that internal audit will work. But I just think it makes interesting reading, because should that be 11% on yes, or should it be an awful lot higher? Or should we all be in part? Should that be 100% to the in part? So when I go through my slides, I don't think I'll bring the poll up again, but a few of you might change your mind, depending on your individual circumstances. So hopefully we can close that poll and get back to the slides. Fingers crossed my colleague will do that now. Brilliant. It's lovely when you've got somebody else sat at home running some things for you in the background. Right, so risk assessments and management is where I want to start when it comes to internal scrutiny. Ultimately, the board of trustees have the ultimate responsibility when it comes to risk management and risk assessments. However, they often delegate this down the chain, and they delegate it down to a subcommittee. That's often the audit or finance committee, depending on your size of your trust. You might have an audit committee because you're a big trust and you have to, you're obligated. You might have a finance committee, you might have some other committee that does finance as well. But Ultimately, it's the Board of Trustees that has the responsibility, and that committee should obviously be reporting back to the board in relation to risk management and risk assessments. You have an obligation to prepare a risk management statement, and you have an obligation to assess risks. If you don't do so, you're again non-compliant with the handbook, I'm afraid. But that risk assessment forms the starting point for your internal scrutiny, or it certainly should. And I'll try and go through this in this lovely little circle diagram that I put on the screen here, and I'll take you through the points and try and explain exactly what I mean in relation to risk management and risk assessments. So item 1 is risk assessments are undertaken. So you should have a massive long spreadsheet of risk assessments where you assess all of your school's risks, all of your trust risks, and you categorize it. And the easiest one I find to explain is a fire. And if I take a fire as a risk for a school, the likelihood of your school catching fire is low. So the likelihood of that risk happening is low. So you may deem that to be a low risk or a green in my book. You want to color code it. The consequence of that happening is astronomical. If your school burnt down, yeah, it would be a disaster, wouldn't you? So the consequence is red. And overall, you might give it score that might be somewhere between medium and low because the likelihood of it happening is low, even though the consequence is high. And you've assessed that risk, and then you do something with that risk. You try to mitigate it by insurance, you try to transfer it by setting up arrangements saying, well, if we can't teach from this school, can we do so around the corner in that sports centre or whatever it may be? And you assess your risk and you try to mitigate it and then be comfortable with the level of risk and how that risk is being dealt with. How that risk is being dealt with is number 2 on this cycle, that risk score. And looking at those risks can highlight high areas that actually raise concern, or you're not happy with how that risk is being dealt with in your risk statement and how that risk is being transferred, mitigated, or managed, really. That can mean that you effectively are asking your internal auditors to look at an area. And that leads you on to item 3, which is the internal scrutiny focused area. You can turn around and say, excuse me, auditor, I'd like you to focus on a section. That section might be payroll because we think it's a high risk area because of X, Y, and Z. Please could you provide us with a focused report on that? And it's governed from our risk management and risk assessment statement. That leads you on to item 4, which is the internal report being received, where your external auditor or your external reviewer, I'm sure we should get away from calling those auditors here because it's an internal scrutiny report. It's just that for the last 5 years we've called it an internal audit report. That report is received by the Board of Trustees. You might be happy with the report, you might be happy with the findings, you might be happy with all the controls, the procedures that are put in place within that report, within that area that you've asked your auditor to look at, and then you use that report to update your risk statement, which is item 5. And then you go, I'm happy with that item, and then you follow the process around again. And you go, actually, we tested that item, we might have deemed it to be a higher risk, but we've got this report providing us with reassurance, and therefore I'm going to update my risk score and go from high to maybe medium or medium to high, and therefore it won't be a focus area for next time around when we start doing our scrutiny again. That's how risk management and risk assessment should be used to focus external scrutiny visits and looking at specific items. If I move on to what should be looked at, the DfE has said in their lovely new guidance that an internal scrutiny programme should have financial controls at its core, its heart. And I find that statement reassuring. I'm in finance, I'm an accountant, I'm an auditor. We're talking about internal scrutiny here, and the DfE agreeing and saying, yes, financial controls should be making up a big part of internal scrutiny. But the emphasis here is a big part, not all of it. Not every single thing should be focused on financial systems and controls. Now, I put on the screen here a handful of items that you can look at. And I picked this from the DfE guidance itself. And each one of those things, there's lots of things to check within, but it gives you an overall picture. And you may have noticed here that I've somewhat segregated out certain things. On the left-hand side, you've got the likes of payroll, banking cash, procurement, funding and budgets, monthly information reports, monthly closed out. That is very financial. That is an accountant's dream when it comes to checking, reviewing and providing a report on. The items on the right, IT, data, premises issues, governance structure, disaster and recovery, they're not financial. They definitely have nothing to do with financials. They may have a financial impact if something happened, of course they do, but on the whole, they are not financial. I get very upset as an accountant and auditor because I'm an expert in the items on the left. I am most certainly not an expert on the items on the right. Don't get me wrong, I've been a trustee, a governor, I think I know quite a bit about governance structures. Do I deem myself an expert? Possibly not. If I've got an issue with governance structures, I might call the NGA as an example to come in and provide me with a report on the governance structure for my trust. If I've got issues with the premises, because I have an old school and maybe a chimney that's a bit dodgy or a retaining wall that doesn't look great, I'm not going to call my accountant up to provide me with a report. I'm going to call a chartered building surveyor to provide me with a report on that premises issue. And the same thing applies to the other two items I've listed here. And these things are specifically mentioned in the DfE guidance. And they, in my opinion, have very little to do with financial controls and systems. Now, what does that mean when it comes to internal scrutiny? Well, if you're looking at your risk assessment and you go, actually, I'm very happy with our governance structures or IT, then you may choose not to ask for any internal scrutiny reports on those items. Equally, you might not be happy. Maybe you've got a school that is a very old school and that comes with lots of issues and lots of problems. And therefore, having a report on the premises issues might be very useful and might might lead into your risk management and your risk assessment very, very well. It's up to you. It's up to your trustees and yourselves to decide on what should be looked at when it comes to internal scrutiny. It does not need to be solely focused on the financials. And I think if you just focus on the financials, actually you may be missing one or two things really here. I think when it comes to what should be looked at, certain trusts will naturally just do financials because they're happy with everything else. I would be surprised if other trusts didn't say, actually, we have 3 visits a year, once a term. I may choose to have my internal auditor, which is an accountant or internal accountants, to do the financial for 2 of those 3. And for 1 of those 3, I may choose to have another expert. And that other expert may be the NGA, it may be a chartered building surveyor, it may be a computer expert to cover IT data, GDPR, it may be some lawyers to cover certain other things. And that's a choice. And that should filter through from your risk assessments and your risk management. But I think what the DfE are trying to say here is, whilst financial systems controls are certainly high on the list, they're not everything. And what I do get very upset about is when accountants try to comment on the things on the right. Now, I most certainly won't, and I think if any other accountants would, I'd be very worried for their professional indemnity insurance because they're not supposed to do that. But you should be asking yourselves whether you're happy with the items on the right and whether you should be covering them off a different way, or whether they're all deemed low or medium or managed risks in your risk assessment. If I move on to the approach question now, I put on the screen here, umbrella versus targeted approach. So I'm going to go through exactly what I mean here. And I'm going to start with the umbrella. And I've got a picture on the screen, hopefully you can all see it. I'm not a fisherman, but I think this is the best way of explaining it, the best analogy I can think of when it comes to an umbrella approach. And if you think about having a net and you're throwing your net out and you're going to throw it out quite wide, and you're going to put it back in quite quickly, you're covering a massive amount of area, but you're only ever going to catch what's on the top, because you're trying to cover a large area in such a short amount of time, and you're only ever going to cover that surface area. You're going to get it back, and you might find lots of little things on the top. And that is an umbrella approach, because you're not targeting items, you're not focusing time and detail within specific areas, you're just trying to cover a little bit of everything, really, just to make sure that you've covered all of those points in the previous slide, rather than maybe one or two. It's quite common with smaller trusts, with single schools within SACs or single MATs as sort of such. And it's understandable why people try to do that. They'd rather have reassurance over everything than nothing. But is it right? And that's the question here. The next approach is a targeted approach. And I'm going to use the same sort of analogy when it comes to fishing here. And instead of using that net and casting it out wide and covering the top area of the pond, think about using a fishing rod. Think about the line, throwing it in, trying to find that one big fish that's right at the bottom, knowing that fish will feed you for the week, rather than catching all the very small ones on the top that'll feed you for the day, really. And that's what a targeted approach is all about. It's looking at areas in greater depth, in greater detail, focusing on those high-risk areas that you think are high, that will link back to risk assessments, and that will add much greater value to your trust, because your internal advisor, your internal accountant, your internal scrutiny provider will be able to focus and provide time and effort in looking at that one area, rather than trying to cover everything in such a short amount of time, which often leads to a lack of value, I must say, more than anything else. Now, I'll give an example. It's wonderful to give trustees a nice, clean, internal scrutiny report. Say we've covered 20 items and we tested some of the system controls and they're all fine. Great. The trustee is going to be very happy that they've got a clean report. What added value did it give? Practically nothing other than a bit of reassurance. Whereas if you said, actually, do you mind looking at VAT as an example? Could you look at VAT? Could you ask your accountant to look at VAT and focus on that one area? And your accountant looks at the VAT and says, well, yes, we looked at your VAT. We found your systems and controls are perfectly fine. You're submitting it right, you're signing it off correct. But when we dig deeper, we found actually you've inadvertently claimed 20% of VAT when you should have only claimed 5%. You claim VAT on certain things that you shouldn't claim on at all. You've missed something called partial exemption status with VAT in relation to sort of nursery or exempt services you've been providing. Ouch, there's quite a few issues there. And when you're doing an umbrella approach, you don't focus on that. You don't get into that much detail. So you can see that a targeted approach can be very different when it comes to the amount of information you actually receive back from your internal reviewer, and how that can enhance, how that can provide you with extra reassurance and give you sort of greater value. So I'm going to launch a poll in a second just about this approach, really. And the poll hopefully will come up on your screen in a few moments' time. And I'm going to say, well, what approach do you think you currently use in your trust? So do you think you actually use the umbrella approach? Do you actually think you use a targeted approach? Or do you think you use maybe a bit of a mixed approach? So hopefully my colleague will bring up that poll in a few seconds and it'll be on your screen. There we go. Just click on the button now whether you think you try to cover lots of areas when you're doing your internal reviews, and you ask your auditors to come in and look at everything, you know, bank, payroll, that, provide a report on all the controls, or whether you actually say, I'd like a targeted approach, come and do this, or maybe a bit of both. Maybe you say, actually, I'd like you to look at payroll in detail, but could you look at everything else as well? I know it might take a little bit longer, but I'll pay for that. Obviously, there is always a sort of set-off here. Your auditors can't check everything in detail. The time costs and the fees would be horrendous, and you'd never pay the bill. It's as simple as that. Okay, so let's close that poll, and hopefully we can share the results straight away, and my colleague will do that now, all being well. Okay. That's interesting, isn't it? So I think we've got a 50-50 split when it comes to umbrella versus targeted, really here. And we've got a good chunk doing the mixed approach, where they're doing a bit of both, really. I think from the guidance that the DFE have provided us recently, is they want you to steer away from an umbrella approach. They want you to use your risk statements and your risk assessments to target, really. You can target while still doing an umbrella, which is the mixed approach, which I think you've seen 43% on the screen now are doing, which I think is fine, because that's sort of the hybrid approach. I think if you are doing an umbrella, it might be something that you will be sort of slowly but surely encouraged to move away from, and encouraged to be a bit more focused. But I thought, if that's an interesting one to share, hopefully you've got something out of that poll there, and we can close it down now. My colleague will hopefully close it, all being well. Oh, the polls are working perfectly today. This is a first. Normally half of them don't work. Okay, so let's move on now to up and coming submissions. And the first thing I've got here for this item is the Academies planning calendar, only because I absolutely love the calendar. Just goes to show how sort of bad I am here. It sets out all your financial requirements in one place on a calendar. Wonderful. You can download it, you can stick it on the wall behind you, you can have it as a setting on your computer background if you really want to. Sadly, it's not been updated to reflect all of the deadlines because of COVID. So if you look at it today, it's wrong, I'm afraid. The list items on the DFE website is correct. They have been updated. The calendar hasn't, which is a shame. The Academy's accounts return, hopefully, you're all submitted. Hopefully, everybody has signed off, submitted their Academy's accounts return this year. The deadline was the 23rd, 2 days ago. So all being well, it's all being submitted. The form, I must say, was an absolute nightmare this year. Horrible. Every time and every year, the DFE, the FFA try to improve the form, and like everything, they fix one thing, they break two others whilst they're doing it. Same thing this year, lots of issues with the form this year. If you had a new school join your trust, or if you took over a new school from another trust, the form fell over. They broke it, and it ended up having to go back to the DFE, back to your approver, back to your auditor, back to your approver, and then finally you could submit it again after a great big farce, really. Strangely enough, you only find these issues when it's being done, and it's normally the last minute. But hopefully yours all went through. We got all our answers through, thankfully, in spite of the issues with the form. I thought I'd mention this one, even though the deadline has passed, because of what is happening in the future with it. And we've got potential automation. And for a lot of trusts, you ask your auditors to do it. For a lot of trusts, you do it yourself. It's different, really. I think everybody would be happy with automation of the AAR, especially if you're a MAT with multiple schools. The benchmarking part of the AAR is an utter nightmare. And then you suddenly figure out that you inadvertently put £1,000 in one box that you shouldn't have, and the whole thing throws out errors. Well, we could have potentially automation going forward. You may have heard last year we had the chart of accounts being brought in by the Department of Education. Here's the model chart of accounts. Well, that model chart of accounts was to effectively allow this to happen. If they brought in this model chart of accounts, then it meant that providers, software providers could adapt, could change, could use that model chart of account within their systems, and then their computer systems can be used to filter into the AR automatically, and therefore it automates. When we'll get there is the million-dollar question. Do I think it'll happen by this time next year? No. You just think about your own chart of account within your accounting system. How many codes have you changed? How many things have you added? Well, to follow a prescript chart of account is going to be very, very difficult. And equally, how many adjustments do your auditors make to your accounts? Quite a lot. It's very rare to see trusts put their pension calculations through their own finance system. Normally your auditors and accountants do that. Well, to allow your AAR to be automated, you would have to put that in your system before you did the AAR. So it may bring forward some of your opening balance adjustments or change your opening balance adjustments. But I think I can live with updating opening balances if it automates the AR going forward, because it means a huge amount of saving on time and hopefully costs as well when it comes to trusts there. Next item I've got is the rates relief. So a bit of a refresh, and I appreciate I'm probably teaching a lot of you to suck eggs a little bit here. Academy Trust being charities, they get an 80% rate relief reduction, unless you're a special schools trust, in which case you don't pay rates at all normally. But most trusts, you get an 80% reduction, and you have to pay 20% off over to the local council here. Then what you do is you reclaim that 20% from the Department for Education. Oh, bit of a nightmare. I wish you just didn't have to pay it over in the first place. It'd be much easier, but it's like it's in a different pot of money, it's in a different budget, hence why it's done this way. We are still coming across lots of people and lots of trusts that forget to do it. When we look at their audit, even though rates is such a small amount and immaterial to the audit, so it's never going to affect our opinion, it's missed. And it can be a few £1,000s per school. Don't forget to do it. It's due in April. You should get your rates bill. When you get your rates bill, there's nothing to stop you doing the reclaim straight away after it. And you should do. Make sure it's done. The next item is the School Resource Management Self-Assessment Tool, the SRMSA. It's an acronym I'll never remember, and I don't know why I bother trying to shorten it. Now mandatory. You now have to do it. It is due April 2021. I want to say the 15th of April. The exact date was announced yesterday. I didn't get a chance to update the slides here. It's now mandatory. You have to do it, I'm afraid, this year. Optional in prior years. BFR, BFRO, BFR 3-year is the next thing on my list. It's going to be a combined form. Obviously, we had some changes with the BFRO, BFR last year because of COVID, one being just totally cancelled, the other one being deferred. We've got a combined form this year. It will go live on the 22nd of June with a submission date on the 27th of July, just before you sort of finish really there. I think the good news is it's one submission rather than two. Always happy for that. That's work to do. And equally, we've got a bit more time to do it this year. It was planned the BFR for April with a submission in May, so we've got a couple of months grace there. Always happy to have a few more months to do things, especially when we're still running around trying to sort things out at the moment with everything going on COVID-wise. Okay, moving on to the next agenda item, which is the benchmarking report. Now, as I mentioned earlier on, we are part of the Crestons Group. We are one of, I think, two, possibly three now, accountants in the country that produce a benchmarking report for academy schools. Ours has been produced and published, and this we're talking about for the year ended August 2020, so the one you've just finished your accounts and your AAR from. You can download our benchmarking report for free on our website, and you can use it to see how you compare to other trusts, to other schools, both at primary level, both at secondary level, and then at trust and MAT level as well, across all sorts of things from income expenditure, from capital items, from SIF bids. Everything you can think of is in that report, and it can be used to highlight key areas where maybe you think you're underspending, overspending, or you're not investing enough time in. Feel free to download it at your leisure. Some of the good things this year I'm going to go through are the highlights. Now, it's 40 pages long, so I'm certainly not going to go through every single page, and it's full of numbers amongst other things. But I'm going to go through with you today the highlights from the report. The first thing to note is obviously this year has been, well, a unique year, I think we can certainly say. I don't think we'll ever have this year again, you know, that's why I hope not, really. The impact has been huge on schools. Now, the surprising thing is what's happened to budgets and what's happened to surpluses when it comes to schools and trusts. And I think most of you will probably agree, if you look on the picture on the left-hand side here, that you've probably spent less across a certain number of areas. Supply costs. Well, you've not been in school. You didn't need to pay for supply to cover the tutor that was ill because the school was being closed, other than potentially for key workers. Maintenance costs have gone down. Property costs have reduced. Energy costs have gone down for most schools. Education supply costs have gone down. There's been a lot of savings across a lot of areas when it comes to trusts. However, on the other side of the coin, there's been huge investment in capital items. The amount of laptops, the amount of iPads being purchased for students is astronomical this year. And the reports are saying to us that schools have been out buying an awful lot of capital items this year because of the remote learning they've had to do, unsurprisingly. Obviously, the massive sting in the tail is the loss of the other income, which I know all schools are very upset about because the department has not given them any money for their loss of income. They've allowed them to reclaim for extra costs, which is one thing, but not loss of income. So I think every single school has lost some sort of income, whether they be before and after school clubs, whether it be parental contributions towards meals or nurseries, or whether it's facilities that couldn't have been rented out. There has been a loss of income for trusts. But it's been a bit of a seesaw approach when it comes to, well, we've made savings over here, we've lost income over there, where are we when it comes to overall? And this is a bit that's surprising, because on your screen is the financial performance. And we've tried to split this in our sort of, I don't know what it looks like here on the left-hand side and the right-hand side here, but we've split it between primary, secondary, and multi-academy trusts. And what it shows is the in-year surpluses across those sectors, across those areas, whether it be primaries only, whether it be secondaries only, whether it be maths. I think you'll be surprised. The in-year surplus for primaries this year, on average, is higher than last year. So in spite of all the issues that have happened, in spite of all the income that have been dropping, the average primary in-year surplus has been 25,000 this year. Last year was 12. The previous year was a deficit 18. So it's actually still moved forward. Surpluses are still happening. Secondaries, if you look at their figures, wow, the average in-year surplus for a secondary in 2020, £147,000. Last year, 13. They seem to have gained significantly this year with everything that's gone on. If you look at maths, they've again moved in the right direction. Their surpluses have gone up as well, certainly not as much as secondaries. And on the whole, that's because most maths are either mixed or primaries. There's a lot more of that end than there is just secondaries, really. But even maths are reporting surpluses across the board this year. And if I take what we're showing on the top left here, those trusts that are reporting deficits have even managed to lower the deficit. It's gone down 8% to 5%. So it's showing that finances, whilst it's been challenging, actually, it's been a bit surprising too, to be honest. Now, one thing I've just mentioned on the bottom right here is gag pooling. This is where all of the income, all the gags are put into one pot and distributed out. The one thing that seems to be a common theme now is that it's becoming more common across maths. Gag pooling is becoming more the norm, a doubling this year. I think even though it's been a doubling this year, it's a bit of a 50-50 split over do you gag pool or do you not, but it seems to be moving in a direction. That direction is pooling your gag rather than having it separate. In the future, what have trusts said to us? Well, I think an alarm bell has suddenly gone off. We all realise that we need more IT. We need to build in resilience just in case we have to do remote learning again in the future. So when it comes to IT equipment, there's going to be a lot more investment in that, whether it be capital items or whether it be leasing. Obviously, I'm talking about operating leasing, not finance leasing. You can't do that. But a lot of trusts are saying, we realise we've now got a problem. We need to try and address it quite quickly. That's where they're going to be looking at spending money in the future. And then the final thing on this sort of slide is the maths situation when it comes to growth of maths. there's been a slowdown in the growth of maths. I think that's because COVID has slowed everything down, to be honest. I don't think there's been a slowing push. I think maths are still encouraged to take on other schools. I think maths are still encouraged to merge. We've definitely got a shift into larger maths. Whereas before, you might have seen a math take on maybe 2 or 3 schools in a year. There's been a lot less of that. Maybe it's just been 1. So everything seems to have taken an awful lot longer when it comes to maths and growth. Okay, moving on to COVID-19 funding update. I just wanted to briefly mention the additional costs here because there has been some subtle changes. It's very subtle, but you may recall that if you had a surplus, you couldn't claim for your COVID costs and had to use your surplus. That was the original guidance when it came out, surplus first. Well, it has changed ever so slightly. You can still have a surplus if you're paying off a deficit and still claim. So slight subtle changes. If you're one of those schools that haven't been able to claim in the past because you didn't think you were eligible, just have a quick revisit, just to make sure. This guidance gets updated quite frequently. And these little changes can often mean, and I know a handful of trusts actually that weren't able to claim that now can claim because of the change. There has been a mention about the further round being discussed. I think it's watch the space, see where we are when it comes to that. Obviously, we've got schools reopening again. Wait and see on that one. I think it all depends on what happens going forward. COVID catch-up funding. Now, I'm going to mention a bit more on catch-up funding right at the end in light of yesterday's announcements. But what we know about catch-up funding is that there were spending rules will apply, assurance work will be required, and this great big question mark over by who and how. Now, the report says that Ofsted will be carrying out some sort of checks on how it is spent. There is still discussions, we believe, going on over whether that assurance work will be in addition to something else. And that something else might be auditors coming in and checking. So us coming in and checking how you spent it. Well, that's great. We can't tell you what the impact is on that spend. We're not educational experts. We can see when you spent it on something, and it obviously shouldn't be on something normal. It should be catch-up provision, really. You will need to have evidence. We think maybe you might have to produce some sort of pupil premium report where you say we have this amount of money and this is what we did with it and publish that. We think that might come in relation to the catch-up funding, but it's waiting and see here in that regard. Okay, I'm going to move on to the school's resource self-assessment management tool. And the whole purpose of this tool is to help trusts ensure that they have a good level of financial health and management. And that's exactly what the DFE says in relation to the tool. What you have to do is 2 things. The first thing is complete the checklist. Now, this checklist has got a lot of questions. Now, some of you may remember SFVS, Schools Value Financial Standards, which was before that FEMSIS, I think, from memory, and the nightmare that SFVS was. And when you converted to an academy, you went, yes, one extra thing I don't have to do, thank you, I'm definitely converting. Lo and behold, the checklist is practically the same, I'm afraid. It's your version of SFVS, where there's a lot of questions you have to answer with supporting evidence, and you have to provide it as part of the tool. The second part is what I call the raw data entry. Now, they have said most of this data will be pre-populated from your Academy account return and will filter into the system automatically. I love it when they say that, because they say it and often it doesn't work, and you end up having to key in manually. So it's wait and see what is pre-populated from your AAR. You may have to put in an awful lot of data, you may not, depends on how it works. I think everyone will be different, really. I put on the screen a couple of the questions that they've asked on the governance section. Obviously, some of the questions are very easy to answer. You know, has your Chief Financial Officer read the Academy's financial handbook? Well, they most certainly should have. Yes. There you go. question answered. How do you provide evidence? Well, maybe you might minute that they've read it and they confirm that they've read it, and then instead of minutes, there you go, that's job done, there's the evidence provided, you've marked off that question 30 lines ago, really. So there's an awful lot there to go through, and please note, it's mandatory now, you have to do it. You can't not do it. What does it give us? Well, it gives us a dashboard. It gives us a bit like the old Ofsted dashboard that we had for a couple of years, with RAG ratings across a number of areas. And that's spending across staffing, premises, resources, and energy. They're the main areas of cost, and staffing is sub-split between teacher support, admin, leadership, all that sort of things. It shows you reserves. It looks at the school's characteristics, in other words, average teaching costs. It looks at pupil-teacher ratios, and it looks at outcomes, progress aid, progress across key areas. And it gives you that RAG rating. And that RAG rating is light green to red to show where your school is when it comes to the dashboard. And I always say with these things, someone's got to be in the top 10%. It doesn't mean there's anything wrong with your school that you're in the top 10%. If you're not in the top 10%, somebody else is. Doesn't mean it's wrong. You just have to understand why, and if you need to do something about it, you might be perfectly happy. Really, if you've got a very old-fashioned school that's not got double glazed windows and not got insulation, obviously its energy costs are going to be an awful lot higher than a brand new one. That's quite obvious. Therefore, if you're in the top 10 to 20%, I wouldn't be too worried, really, because of the context of what it is showing you. I put a link to the website. The tool is now open, I believe. You can actually go in and do it today if you want. You may not, it's up to you, but there you go. Next item on the agenda, probably the one that you're all here for maybe, is the tax refund for employees. And the first thing I'm going to start with is working from home, and I'm going to bring up my final poll, I promise you here, it's the final one. So hopefully my colleague will bring up the poll now. And I just want a flavour for how many of you have actually claimed tax relief this year in relation to working from home. Have you? Yes or no? Could you quickly answer whether you have? Obviously it won't share who you are, you know, there's no harm in it, but I'd like to see how many of you. I might certainly not do this section if you all have, because there's no point. Okay, hopefully you've all clicked the button there. Can we now close that poll and hopefully share it? Oh, okay. So most of you haven't. Wonderful. Oh, right, you might get your pen and paper out now. And if you do, and if you get some money back, I'll give you my private address and you can send me a bottle of wine. No, I'm not allowed to take wine, unfortunately. Anything that's non-alcohol, that's fine, because you shouldn't be paying for anything with alcohol for your trust. You've got a regulatory report issue. Chocolates are fine though. Can we close that poll? Thank you. Okay, poll is closed. I'm going to talk about working from home, and I'm talking about the guidance here from working from home. Working from home. If you've worked from home for one day this year, just one day, the rules are different to previous years, the first thing to note. When it comes to teachers, when it comes to TAs, when it comes to an awful lot of admin staff, the answer is yes, of course you've worked from home for one day, especially during the first lockdown when everyone was just like, school is closed, everything's closed, we're closing schools, we're closing everything, you're all working from home or you're all at home. If you've worked from home for one day, then you qualify for the full year. It's important to note. How much is it? Well, it's £6 a week, £312 for the year. That's the allowance, not the money you can get back. The money you get back depends on your personal tax position. So if you're a basic rate taxpayer earning less than £50,000, by claiming this, you'll get £62 worth of tax back. If you're a higher rate taxpayer earning more than £50,000, it's 125. I've not mentioned additional taxpayers because I get very upset when we talk about additional rate taxpayers. I don't know about you, but I'd be very happy with £62. That will certainly go a long way in paying for my meal out come June or July time, whenever it will be. I can't wait for. And why aren't you claiming it? Should you've claimed it? Most certainly if you've worked from home for one day. It is money for old rope. How do you claim? There's one of three ways here. You can go online, you can set up a government gateway account, take about 10 minutes, need some sort of ID, password, so ID as in passport rather, driving license, and you can set up that way and claim that way. You can complete the form online, called a P87 form. You complete it online, you print it out, and you send it to the taxman. That's slightly quicker doing it that way. Or you can call the taxman, and I'll put the number on the screen. If you call the taxman, you will be on hold for around about 40 minutes. That's the average wait time, dare I say it. That's not the most time-consuming way of doing it. And the form is there on the screen. Now, you know about this. What about all the staff? What about all your teachers? What about all your TAs? What about all those other people that have been at home? Now, if I were you, COVID depending and COVID security, you might spend the day doing this with them. If you're the CFO with us today, then just think of the kudos you're going to get if you sit down with the staff, COVID security, just comment in there as well, and you do the form with them. £62 minimum for every single member of staff if they've worked from home for one day. That can be a huge sum of money, and when times are tight, things are difficult, if you can get hold of £62 for 10 minutes work, why not? You most certainly should. There's an awful lot of people out there that are doing this. Why aren't you? Next thing is professional subscriptions. When I talk to higher ed taxpayers, when I talk to head teachers, I often ask about professional subscriptions, and I'm always surprised when it comes to professional subscriptions. The first thing to note is that you must be paying them yourself. The norm now is for trusts not to pay professional subscriptions. It used to be that all schools would pay professional subscriptions, and I think then it went to we'll pay one, but not any more than that. So if you're a member of two, we'll pay for one of that. Most trusts don't pay them now. Your trust might be different to that. Your trust might be one of those that certainly does. But if you or a member of your staff pays a professional subscription yourself out of your own back pocket and your employer, the school, the trust, does not pay, then you can claim tax relief on that subscription. There are hundreds of professional bodies, dare I say it. The list is huge. I've put the list on the screen here that you can click onto and follow through. The most common ones when it comes to schools, the Teachers Union, the National Union of Teachers, sort of the NUT, the National Association of Head Teachers, and the 6 main teaching ones. And then there's lots of what I call association ones. The Association of Mathematicians, Association of Math Teachers, Association of Science Teachers. There's literally hundreds of them. And if you are a member, you pay them a subscription, and if you pay that subscription, you can set it off against your employment income. That reduces your tax. And I'll give an example here, and this is a very straightforward, simple example. This is not one that I've sort of made up, other than I've changed the name. Yeah. So we've got Sue, head teacher, earning £65,000 a year. She's personally paid professional subscriptions of £432 this year, which is the annual subscription rate for the National Association of Head Teachers. And she's worked from home for at least one day. Virtually every single teacher has. If I take the subscription and I add it to the work at home, that gives me sort of £744. She's a higher ed taxpayer. She gets tax relief at 40%. She's got a £300 or near a damn it refund for 10 minutes work. I don't know about you, that's quite a few meals out when we can finally get out and go to a pub and go to a nice restaurant. Make the claims, speak to your staff. They will be very happy to know that they can get a tax refund back if they can. When it comes to professional subscriptions as well, unlike use of home as office, you can go back 3 years with professional subscriptions. So if you've missed last year's and went, oh, I paid last year's, that's a shame. Doesn't matter, you can go back last year and the year before that and the year before that and claim. So Sue here might find that £300 is more like nearly £1,000 because she can go back many years. Okay, moving on to the next item, other matters. Now, this is the item that I sort of tagged on right at the end, and it's not shown in the agenda. I've got a few things just to discuss on other matters. The first thing is the Teachers' Pay and Pension Grant and how it's going to change. Now, for Academies, there's a couple of changes. The first thing to sort of note is we've continually got the separated grant up until August 2021. So you'll still receive your grant in relation to the teachers' pension and teachers' pay grants separately for this academic year. But from September 21, they'll be paid through the NMF. So in other words, they'll come through like your GAG as such. So it's worthwhile just checking the methodology, the pupil rate, just to see whether there's been any impact on the amount you're receiving. Now, if you're mainstream or if you're a special school, your funding is slightly different and you will continue to follow the sort of period to March each year rather than the academic year, and therefore that will start from April 21 rather than from September 21. The next item here I've got is EU procurement OJEU rules post-Brexit, which is a bit of a mouthful, to be honest with you. And I've put this on the agenda because I've had quite a few comments and queries from my clients and from other people asking about what they should do now when it comes to tendering post-Brexit. So let's just remind ourselves on what this is all about. If you've got a large contract, maybe you were successful with a SIF bid, then naturally you have to go out to the European Union with your tender, follow the OJEU rules depending on the value of your tender, and invite effectively businesses across Europe to tender for your services, really. Now, we all know that we're no longer in Brexit. The transition period ended on the 31st of December as such. So what happens in relation to this rule and regulation, knowing that it is included within the Academy Financial Handbook, which covers the period all the way through to the end of this academic year. And the question I get asked then is, do we have to follow the OJEU rules, which is stipulated in the Academy Handbook, or not, knowing that we are now out of Brexit? And the answer to that one is, if you have started your tendering process before the 31st of December, then you do still have to follow the rules. If you started the process after the 31st of December, in spite of the requirement of the Academy's Financial Handbook, you do not have to follow the OJEU rule, and it will not be deemed a breach of the handbook if you don't do so, as long as that process started post 31st of December onwards. Next item on the list here is the proposed Auditor's Handbook. We've got a new handbook. You all know that we've currently got a few handbooks lying around in addition to all the guidance that the department gives us. We've obviously got the Academy Financial Handbook and the Academy's Accounts Direction. Well, we've got a new one on the agenda, a new one on the horizon. Actually, it's not called the Auditor's Handbook. They've come up with a new name called the Auditor's Guide. I don't think they want to confuse everybody by having a handbook as such. You're probably thinking this is purely for auditors, for us. Well, in reality, it's for both. It's for auditors, and it's going to be for you as well and your trustees to have a look to ensure that you understand what we are doing. I'm not convinced this one will be published this year. I think it will probably come out the year after. There's lots of consultation around it because obviously auditors have to agree with what they're doing. It goes through our regulatory bodies and they approve it before the ESFA can actually publish it, and then we follow it as such. So it might take a little bit longer to implement than expected, but it's coming. It's just a matter of when rather than if. Some other items we have on the other matters, and this is very hot off the press because this is in relation to the recent announcement that the government has made in relation to catch-up premium amounts and payments. Now, we all know when it came to the catch-up premium, it was based on pupil numbers, and that was the census in October 2020, and the amounts were £80 per pupil or £240 if that pupil was in an SEN setting. Everybody should have received their first payment, which was 25% of the amount, and that was paid on the 8th of October. And then yesterday we got the announcement that the second payment will be paid on the 8th of March, but instead of it being 25%, it's actually 33.3%. I don't know who thinks up these percentages. There must be a reason, rationale behind it. It's just awful to follow through, to be honest with you. We also got the third and final payment coming sometime in 21. And if my maths are correct, then that should be the balance, which makes the percentages look awful, to be honest. I'll be amazed if you can figure out exactly what you're getting, how and when here. That will come sometime in 2021. We haven't got the exact date on that one yet. Watch this space. Could be towards the end of the academic year, maybe over the summer period, that sort of time, really. Now, we have the announcement of the education recovery package, and I love politicians, to be honest with you, because the announcement was an additional £700 million for schools. And when I looked into the detail, I'm not convinced it's an additional £700 million, to be honest with you. I just think that they've moved some money around more than anything else. I do agree and I do accept that there does seem to be around about £300 million worth of extra income that's been thrown in, and they say this is for building on pupil premium. Obviously more guidance will be issued. I didn't know whether that meant it was just aimed at pupil premium children, or actually it was for all children to help them catch up. The average is going to be around about £6,000 for every primary, £22,000 for every secondary. Watch this space on the conditions of that grant and whether it's purely for PP children or not. They said of that £700 million, there's £200 million for the tailoring programme. Now, we already had the announcement for this tailoring programme. I believe the tailoring programme was actually £300 million before, not 200. So they've knocked £100 million off that. I made it 200 million, hence that's certainly not new. Actually, it's a reduction of the amount, and that's all to do with development and language development for early years and tutoring program for all other years, everything from early years settings right the way through to 16 to 19-year-olds. And then we've got the final face-to-face summer school announcement, which was 100 million and is now 200 million. So I think they've stolen 100 million from the tutoring program and slotted it into the summer face-to-face announcement here. So there's 200 million pounds, and that is purely for secondary schools, targeting incoming year 7 pupils to give them a bit of an uplift when they start on secondary provisions. You'll be pleased to note that that is the end of the slides. It was a long session. As normal, I overran. I said it'd be about an hour. I know my team would give me an hour and a half. So apologies there. They were right and I was wrong. I have received one question during the session, which is all about internal scrutiny. And the question is, how many scrutiny reports should my school and trust have during the year? And whilst the handbook doesn't stipulate how many, I think good practice and the norm is to have 1 a term, so 3 in a year. Obviously, the minimum requirement will be 1 because you have to undertake internal scrutiny as such. 3 is norm, 1 is minimum. You might find that somewhere in between may suit your school and your trust there. It all depends on your needs and requirements, and obviously assess your risk assessment and link it back through to what you should be doing on your internal scrutiny. I do hope that you found that webinar interesting. If you've got any questions, please feel free to drop me a line, use my email address, and hopefully I'll be able to answer them. Thank you very much, and I'll leave you to it. Have a nice afternoon. Bye-bye.